Welcome to our residential review for the first quarter of 2026. For a few years now, we have specifically been working on holding, operating, and opportunistically selling our residential assets. Over the years, we've done 70 different deals, and we have 16 of these left right now. One of the biggest changes we've seen in the first quarter is that our rental rates, really for the first time in probably 15 years, have been basically flat year over year and flat quarter over quarter. So that has a big impact on how we operate the business. But let's first just go through some statistics of where we're at. I mentioned we've done 70 deals in the real estate space focused around residential, which is either apartments or mobile homes in our world. We have 16 of those that are currently left.
So over the first quarter, we sold Baker & Glover, which was a big win. That was one of our mobile home parks. We have Westside Townhomes under contract that should close in April. And we have Eastside Crossing, Fairway, and the Grove out to market. They've been under contract before. We've worked through with a couple different buyers, between negotiations, between retrades that just have not fully gone through on the sale. We're going to keep trying, but in the meantime, we keep operating.
Yep. The Fairway and Grove have been about a year, more than a year, that we've been working on the sale process. Eastside Crossing is new to that mix, and we really have our call to offers here at the end of April. So we'll be going through that process, but in general, it's been a very lengthy kind of back and forth due diligence process.
Yeah, we've seen that on a few of our past deals. Even Westside Townhomes, we should get to the finish line in April. It's taken a few contracts to actually get there. So.
Yeah. Historically, it's always been kind of a momentum sale or momentum trade that the markets just keeps going up. So people can buy our properties that we've been focused on retention. Our average rents are, say, $1,000. Rents keep going up, and so they can think they can get $1,200, $1,300. Well, that trade is no longer there. So they're deeply underwriting the current existing condition of the property, whether it's current collections, whether it's occupancy, whether it's realized collections, the difference being tenants that are there, tenants that are paying, and then, of course, the condition of the buildings.
Yeah, definitely. We look at our statistics really for the first quarter and how we did. I mentioned this, our year-over-year revenue growth was 3%, which is still positive, so that's a good thing, but that's very flat compared to where we've seen things really over the past 12 to 15 years. And then quarter over quarter, it was 0%. So first quarter was 0, fourth quarter was 0, third quarter was 0. It was really only until we go back to the first quarter of 2025 that we're seeing rental growth compared to that time frame. So for us, that basically means it's flat. On the retention side, this is a huge metric for our business and how we operate. We saw 62% in the first quarter. That means if we have 100 leases that are ending, 62 of them signed and extended for another year. Our target on that is 70%, so 60% is a little bit below where we want to see things. With revenue growth, rental rate growth being flat, there's a lot of options out there in the rental space right now that gives tenants a lot of flexibility. If we look at our average rental rates, it continues to hover around the $1,100 a month rate. That is where we're seeing our rental rates, and it's been that way now for a while.
Yeah, with rental rates really flatlining, our retention being in the 60s, historically targeting the 70s, we really want to change that and really start pushing to 100% retention. Duncan had a good point earlier that if we're not going to see the rental growth, why would we spend the money on turning over the unit? So how do we hunker down and kind of keep the tenants that are there?
Yeah, really going to adjust that goal, 100%, but looking at it on a unit-by-unit basis, like, hey, can we go secure more market rent here, or are we just going to get the same thing if we go lease it to somebody else?
Yeah, and that's why our strategy, one of our main points here, is that with flat rental rate growth, our shift on retention needs to be, we need to retain as many people as possible. There used to be an analysis we could do where we'd say, hey, if we did spend money on our turnover, how much more are we going to capture in rental rate growth? And we said, if we can spend turnover dollars and get somewhere between 2 and 3 years to earn that money back, that was a good investment on a gross multiple, on a per unit gross multiple. But now it's looking like a turnover cost is just going to be a net outlay, and there will not be a revenue gain captured with that. So therefore, we have to shift dramatically on what our retention targets are.
Yeah, and we've talked about this a lot in the past, but really the main drivers of retention are pricing and service. So from a service standpoint, We do a lot of stuff through our foundation. We do summer camps, we do outreach projects, we do grocery delivery, et cetera, to help make the tenants have a better experience, especially if they're going through a hard time in just a moment in life that we can help out in. Our seasoned staff, I mean, our average tenure on our residential team is probably pushing 6 years, maybe 7 years. So we have very experienced staff that knows how to connect with our residents, and I think we do an excellent job on the service side. And so now it's just really a pricing game of what's going on in the market.
Yeah, we do the move out surveys whenever somebody moves out, and it's typically, it's never really service. You see, a lot of residents move from one Greenleaf property to another Greenleaf property if they're relocating for a job or for family reasons.
Yeah. So with this shift in the market of rental rates, that kind of leads into the point of like, is there going to be an opportunity to buy stuff? And we've continually been on the sidelines. We haven't bought anything now in 6 years. So it's been quite a long time of not purchasing something. Really, the only reason we would see to change that is as operators, if there's an opportunity to come in and fix a problem that's existing. Is there something that doesn't work well in the market, or is something just not happening that needs to be happening? That hasn't happened yet, but we're starting to see deal pricing that's getting much more attractive. And we're also starting to hear that deals that were done in 2021, 2022 are coming up into this 4 to 5 year debt target. And there could be lots of deals that hit the market, but there also could be none. We're kind of hearing lots of stories. We're not actually seeing any activity.
Right. A lot of buyers are still comparing the price point to the peak price point, which was in 2022. And it's pretty challenging when that was kind of almost a nonsense price point. Like people were buying deals at 3 and 4 cap rates. They didn't cover debt coverage. They were all just betting on the momentum. Now that ship has really sailed, and we're looking at still comparing prices to 2018, 2019. How do we get back to that? Because frankly, rents have not really moved that much more.
Yeah. Well, the momentum they're banking on for that is now flat, and it's not moving forward. So there should be some opportunities that come up from that. But that's really the only thing we're looking at, saying, hey, we will make a shift in kind of what we're doing if we see that happen. Right. So, and it could be, I feel like we've said that for a while. Could be next year.
Right.
We continue to look at them.
Yeah.
I think the two value add drivers that we'll see, potentially, the sponsors not wanting to put additional capital. We've seen that across all asset classes, where we come in, put the additional capital needed to take it to that next step, or just the operations play. We have a great operations team, as you said here. So really taking those, the operating costs and shrinking those down to expand margins.
One of the other interesting things we've seen on our mobile home sales specifically is the emergence of goodwill. So if you look at goodwill on a balance sheet of a normal business, you're trying to place a value on brand recognition or an associated intrinsic value, non-intrinsic value.
Yeah, non-tangible value.
Non-tangible value with the asset. But a lot of our recent offers on the mobile home space have used goodwill in the purchase price to make their offer more attractive on their side. And what that means to us is there's a significant tax difference on how those things are treated.
So when we sold Russell Village last year, we allocated, I think of the $6 million sales, around $1 million, $1.5 million to goodwill. What that means to us is that we can't 1031 exchange that money, which was fine because that was enough that we wanted to exit anyways. But what it means to them is that they don't get the full mark to market on a local property tax value. So normally when you sell a property for $6 million, you get the property taxes based on $6 million. But if you throw some goodwill in there, now you're getting property taxes based on $4.5 million. And that's a significant savings when you're looking at operating the property long term.
Yeah, a lot of property tax rates have gone up dramatically really over a 10-year period, it's been significant. But even over the past 4 years, we've seen property taxes rise roughly 100% to 200% across all of our residential and a lot of our commercial assets as well. So now property taxes used to be a couple $100 a unit on the residential side. Now it's a couple $1,000 a unit. So it's a huge cost component. For us, having a lower basis, property taxes are typically our largest costs that we're paying on an annual basis. And it's taking up, in some cases, almost 4 months of rent are paid specifically to property taxes. So finding ways to abate that is a big selling point in the market. And specifically in the mobile home space, we've seen this as a way to, one, for us to realize higher sale prices, but also for the transactions to actually close.
Right. Yeah. We've seen buyers, do this where they're allocating real property in a different way to the state of Georgia through form PT-61, I believe, which is really the form that the state of Georgia is going to use to recognize the sale and then go, reappraise the asset. So, it's just been beneficial for buyers to lower those taxes.
And mobile homes have several more variables than apartments do, because you can allocate a value to the homes, allocate a value to the land. And then obviously this goodwill is kind of a new entrance to the conversation. So we'll see if that kind of starts creeping its way into other asset classes. We haven't seen it anywhere else yet, but in mobile homes, we're seeing it, and it's active because we've now seen it on 2 deals, and we expect to see it on the future ones as we look to sell them.
Yeah, definitely. In all of our mobile homes, it's a discussion point of any offer that we're having. Is this goodwill component now?
Right.
And the way it's written is the goodwill, associated with the leases on the asset. So, I could see that creeping into other asset classes as well.
Yeah.
Okay. Just to wrap things up here, all of our distributions will go out on the 20th. That's every quarter. We always send them out on the 20th. We have our Investor Growth Day, which is on April 30th as well. If you can make it, that's here in our office in Atlanta. Great opportunity for LPs to network with each other, meet each other. And we have 2 speakers lined up for that day. One of them is a lieutenant governor candidate, which will be exciting. And we have Brian Panosian, also one of our LPs, who will be speaking with us. So we're excited for that. And it's a good time. If you have any questions, we can go through them at that point as well. But keep a lookout for distributions, and all of the quarterly reports will be in our investor portal. Another thing we have to mention is that we are doing webinars for each specific deal. We have about 4 or 5 of these a month that we're hosting, and it's a forum specifically for investors in individual deals to go through what our value proposition is on that deal, what our future strategy looks like, and really sit back, answer any questions, and kind of build what does the future of each deal look like. We have our plan and our execution strategy, so we cover that as well, and make sure we can answer any questions. Okay, thanks for watching, everyone.
Thank you.